What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. I'm your host, Alex Ivanovich. I am a trader and investor at Spoonbill Partners, LLC. We trade stocks, bonds, derivative products, public and private markets, you name it, and we've probably traded it. Gosh, that was a tough intro to get through. It's been a few weeks since I've done that. I know my whole 50 subscribers missed me. A little bit of comedy to start out there. But anyway, we have a lot to discuss. There's been a lot of things going on the last 3 weeks while I've been away. 3 weeks, 2 weeks, I don't even know anymore, but there's been a lot going on. It feels like it's been actually months since I've last made a video, given how much has gone on. We've had hyperscaler earnings, we've had some high profile semiconductor earnings, we've had some high profile software earnings, we've gotten some good data, macroeconomic data, some data from the Fed, and we've had some blowups. I'm not going to even begin to talk about situational awareness and this absolute special character, Leopold. But we will discuss leverage and some other stuff later on in this episode because I think it's a worthwhile topic to discuss. But anywho, we got a bunch of topics to talk about. It's going to be impossible for me to cover everything that has gone on in the last few weeks since I've last made an episode, but we're going to try and cover some of the more important things. So before I even dive into the topics that we have at hand, I just want to take a moment to acknowledge the fact that this has not been a super easy market to trade. A lot of the time, the stock market is disconnected from fundamentals. That is no surprise, no shock to anyone. But more so than ever recently, it feels like things have just completely disconnected from reality. And for a brief moment there, we did have some realistic price action, I think, some much needed selling in a group that I thought was certainly overbought, i.e., the semiconductors. We did see this pretty crazy rally happen in software and some of the cybersecurity stocks. But every other day, there seems to be some data point or some story that shifts the narrative. And more now, the moves in the market are being dictated by these passive flows. Some time ago, I'm not going to say 20, 30 years ago, whatever, some time ago, before passive flows built up such a large portion of the activity in the stock market, active managers would read through documents, go through reports, make decisions on stocks that they liked, disliked, were they going to go long, short, build their portfolios. But now none of that seems to really matter. Michael O'Rourke put out a great piece, and I'm going to misquote him here, but he brought up the fact that Microsoft on their report day disclosed this massive amount of backlog, but that the bulk of it is for OpenAI, that OpenAI is the largest customer that they have. And so when you saw Microsoft gap up on the first day and then sell off, not completely, but it did have some sloppy price action into the close, Michael O'Rourke points out the fact that that is active managers picking up on the fact that, oh, the good news wasn't actually so good. But then the following day, when Amazon ripped, when a lot of other companies ripped higher just on the Amazon report, because I will admit the Amazon report was very good, all the woes in Microsoft went out the window. And that's not because people decided to ignore the news from the day prior, what they found out in this Microsoft print. It actually wasn't an active manager at all. This is algorithmic buying. This is passive flows ripping stocks for no reason. And it's sort of why you are currently seeing the market have this historic run over the past 6 or 7 trading days. We had this very aggressive sell-off in semiconductors, and now a lot of these non-profitable neo clouds, memory, semiconductor names are ripping 10, 15, 20% in a single day, rallying astronomical amounts. Like, the volatility is just insane. And every other day it seems to be that if semiconductors get sold, either the staples are getting bought or the utilities are getting bought, or if oil is weak, then the retailers are getting bought if the semis are getting sold. But if the semis are getting bought, then the software group is getting sold. And some days software is just going to trade with tech in general, which is just semiconductors, the SMH and the SOXX, and they're both going to go up together in tandem. And so it's very difficult to piece together what is going on a day-to-day. And I've read a lot of stuff from a lot of very smart people, and it seems to be that the smartest thing a lot of people did was do nothing over this period of time where there's been so much volatility. So anyway, I'm just providing the context for some of the stuff that we are going to talk about today. That is sort of the setup. It has not been an easy market to trade. There has been a lot of volatility across a lot of different groups. Even though the market has rallied 6 or 7 days in a row and the S&P is back at all-time highs, I have this feeling in my stomach that we are not out of the woods, because this move that just occurred, this 6 day super mega rally that just occurred, is not what happens when mutual funds are putting money to work, when active managers are putting money to work because they truly believe in the stock market. That is a move that occurs that's frantic, that's like frenzied. And it occurred on such little volume that I almost think it's a fade. And again, I don't give any advice on this show, but it feels to me the way the memory stocks felt when they were ripping every single day, and I felt, oh gosh, like a correction is due. Some selling is due at this point. And so that's what I think. I don't know that the Nasdaq or the S&P is going to see a fresh all-time high. We might meander along for a little bit. I also don't think, we're going to talk about this later in the show, but I also don't think bond yields being where they are is very helpful to tech valuations whatsoever. So you can already see my brain is absolutely discombobulated. I'm going off on a bunch of different tangents here, but we will bring it all back together. And I promise that I do have a structured agenda for today's episode. So let's get on with the episode and let's talk about the first thing that I wanted to talk about, which is the hyperscaler earnings. So before I get into any of the numbers, let's just talk some price action real quick. So Amazon obviously blew it out of the water. So Amazon is starting to show you some return on investment for sure. Microsoft and Amazon actually were up like 8 to 10% post the print. Both were, I think, able to alleviate investor concern about the CapEx. I mean, the CapEx still accelerated. I think Microsoft held CapEx steady and Amazon accelerated the CapEx guide, or guided for a little more growth in their capital expenditures on data centers. But regardless of that fact, those were the two companies that are now starting to demonstrate that there might be some return on investment given the Azure numbers and given the AWS numbers. So one of the major concerns that Wall Street has had is, when is this capital expenditure going to start to translate into serious revenue growth and flow to the bottom line? And so you're starting to see that occur with these two companies. And obviously they were rewarded for it. Now, albeit Microsoft, we found out later that a lot of their contracted backlog is with OpenAI, but didn't really seem like the market cared about that fact. So we're going to just gloss over it in this episode for now. So net, it looked like for these two companies, the spend is justified by the bookings and the revenue numbers and the revenue growth that they're posting. The problem with Meta, ad revenue was strong, top line was strong, free cash flow absolutely evaporated, was one of the latest companies have their free cash flow flip positive to negative, missed on the bottom line, and their CapEx accelerated. So what I think is the most important thing to pull from this, Amazon sort of just launched itself into first position by demonstrating that they have a diverse set of, well, I shouldn't say diverse, but more diverse set of customers, a more diverse customer base that is purchasing the AWS product, that is a direct result of CapEx dollars that they are spending. And in my mind is probably a hyperscaler that deserves a little bit of the price action that it has received. Microsoft, I think, is sort of in that second position. Google maybe in the third position, and Meta all the way at the bottom, because I don't think the capital expenditures at Meta, first of all, their models are not even on par with the frontier models. Even the one that was released today, I forget the name of it, is sort of in that number 3, number 4 position and does not compete with OpenAI and Anthropic's models. Gemini has completely fallen off the map. Google obviously does have the Google Cloud component, but it was not as strong as Amazon's number. So I think that's sort of how the hyperscalers stack up. And the question, like I said before, that investors are asking is, at what point does all of this capital expenditure begin to make sense? And so the hyperscalers that start to demonstrate that, even if it's just a little bit, are gonna be rewarded. And so that's why you saw the price action that you saw in Amazon, in Microsoft, and that's why you saw the negative price action that you saw in Meta and Google. Now, despite all of this, why am I still sort of bearish on the spend? Well, things are sort of unregulated. This is a Wild West type of environment. But you just had one of OpenAI's latest models break out of its sandbox environment, meaning they had the model in sort of this when they say sandbox, I guess it's like sort of a test environment. They're testing the model to see that it does what they intend it to do and that it behaves. So basically, the model was so good, it broke out of the sandbox environment. Nobody at OpenAI knew. It started communicating with other models and actually breached the cybersecurity of another company called Hugging Face. Now, I don't know all the technical terminology. I'm not even going to pretend to know. It's pretty scary what the model did. And I think that is a great canary in the coal mine for what's to come in the future. If these models continue to get better, if the CapEx continues to accelerate, meaning the models will continue to get better, meaning there might be more exploitations of cybersecurity and there might be this actual risk, this cybersecurity risk. You're not just going to see the government sit back and say, oh, that's okay. We're just going to let it play out. I said this a long time ago. You're going to see some sort of institution, some sort of FDA-like regulatory body come out of the government, but for specifically AI. So whenever a company like Merck, Bristol Myers, Pfizer comes up with a new drug, Eli and Lilly, you name it, comes up with a new drug, and they need to get it approved by the FDA before they can sell it in the US. And you're going to start to see the very similar thing happen with AI models. It's going to slow the rate of progress in the name of safety, which I'm not going to argue is a good thing or a bad thing. I'm just going to say that it's a fact. It's going to happen eventually. It's going to slow the rate of progress. It's going to make progress more expensive. And we all know how regulatory regimes occur in the US. They really constrict the wheels of capitalism from moving forward. And again, I'm not going to sit here and say that's a good thing or a bad thing. I'm just going to say that that is what it is. And that hasn't even really begun to occur yet. But I think this instance of OpenAI's latest model breaking out of the environment that they had it in, so-called safe environment that they had it in. I mean, if this technology truly gets into the wrong hands, or, I don't really even know what I'm doing with AI a lot of the time. I know to make summaries of these emails, or can you make me a website for this? Can you make me an app for this? I use it for very rudimentary, simple tasks. But somebody who's a sophisticated player, somebody who's a hacker in another country, you name it, them having access to a model like that could be very dangerous and potentially catastrophic. And so I think it's going to get regulated. And so that's why I'm sort of still bearish on the whole AI thing. Do I think it's going to be revolutionary technology? For sure. But I don't think the revenue growth is going to show up as quickly as people think it is. And if that's the case and the CapEx continues to explode, investors might lose their patience. Now, the second reason why I'm still pretty bearish on all of this is the China models, who have really come to center stage recently. So the Chinese models, I don't have the numbers off the top of my head, but they are significantly cheaper to operate. And I know a lot of people's arguments are going to be, well, they're not as good as the frontier models in the US, the models that come out of Anthropic or OpenAI. Well, I would say hold your horses a second. Although that may be true, let's say I'm going to use some arbitrary figures here, because I think they're roughly right. If the model costs 50% to run the exact same task on a Chinese open source model versus a US frontier closed source model, if it costs 50% to run that Chinese model and the answer is only 50% as good as the frontier models, then that's apples to apples. You sort of decide what you want to do. If cost is a concern for you, then you might go with the Chinese model. If performance is a major concern for you, then you might go with the frontier model. But there starts to become this trade-off question when the Chinese model costs 50% of the frontier American models, or maybe even 25% of what the frontier American models cost, but the performance is 80% or 85% of that of a frontier model. At that point, you start to ask yourself, well, is that incremental amount of performance, that marginal amount of performance I get with the frontier model, really worth the double or even triple the cost that I'm paying for that frontier model? And a lot of CFOs are starting to say, no, it's not. We might not actually need the capability that a frontier model can provide. So you're going to start to see a lot of these companies switch to Chinese models, which the mass migration has not occurred yet. But I can start to see, prophesizing a little bit here, you're going to start to see what occurred with Chinese labor and manufacturing, where things were originally produced in the US, but manufacturing and labor got so expensive that a lot of it was outsourced to China because labor was so cheap. And you ended up with a lot of manufacturing companies in the US. They simply just don't exist anymore. And is that the trend that AI is going to take? Are people going to start to use open source, cheaper Chinese models. Because again, if you just take an open source model and you run it on your own hardware, you're sort of safe as long as you go through the model and you cross all your T's and dot all your I's. It seems like a pretty great alternative, and it hasn't even really been explored yet. Like China is still trying to catch up with our frontier models, but they're making things cheaper. And so this price war is going to start to occur. Anthropic and OpenAI and whoever else, they're not going to be able to command the premium price that they've been charging for much longer if this dynamic is allowed to unfold. And so that's why I'm bearish on AI still, despite what Amazon says, despite what despite what Microsoft says. Those are my thoughts on some of the hyperscaler stuff going on, and just on what I've been seeing and reading the last few weeks. So I realize this episode is already running super long, and I'm doing a lot of rambling, so I'm going to try to tie it all back in here. We're not going to talk about yields as much as I wanted to. Effectively, what I wanted to say was the yield curve is going to start to become an issue for tech valuation. Yields are high. It's going to make all the debt issued by the hyperscalers more expensive. I read something somewhere that a lot of these hyperscalers are obviously investment grade rated companies. And so a lot of these investment grade bond ETF portfolios are heavily invested in some of these hyperscalers. And so people who thought they were invested in, I'm just in investment grade American debt. Well, you actually have a large exposure to AI and data center debt as well. So that's sort of an interesting thing. And remember, rates rising makes things in the economy more expensive. It makes the cost of capital more expensive. You need to borrow money to buy a car, that's more expensive. You need to borrow money to buy a house, that's more expensive. It's going to start to creep into people's spending habits, and you might start to see spending slow down. Not to mention, as bonds pay a higher coupon because the yields are going up, that makes stocks at all-time high valuations a little bit less attractive. So you might start to see money flow from equities into some debt securities. But anywho, I don't want to go into the weeds on that topic too much because again, this episode is going to run very long. But I would implore you to pay attention to the yield curve, because if that continues to creep higher, at some point, it's going to be a massive headwind for not just tech valuations, but valuations in general in the stock market. Now, let's talk about this Leopold guy. I don't really know a whole lot about him. Whatever, went to Harvard, started this hedge fund called Situational Awareness, which I think is a hilarious name now that we can look at it in hindsight. I don't really want to give him all the publicity that a lot of people have been giving him. There's so many memes about him on the internet. Everybody knows the story. Everybody knows that Kenny Griffin swooped in and bought his whole portfolio, basically sent the guy a lifeline. What I sort of want to focus on for my listeners is, let's talk about leverage, the dangers, the benefits. So what is leverage? I'm just going to try and say it simply. You're effectively borrowing money to make a bet bigger. So if you're 4x levered, for every $1 of yours, you control $4 of exposure. The nice thing about this is that you keep the gains on the borrowed money. And how it helps, it obviously amplifies the return on your initial principal. 4x leverage allows you to control a larger position with less of your capital. But as the old adage on Wall Street goes, leverage cuts both ways. So yes, it can amplify your returns, but if you're wrong, it severely amplifies your losses as well. For example, like a 17% drop in your portfolio at 4x leverage is actually a 68% wipeout. That's catastrophic, right? And if that happens, you'll get something called a margin call. The lender who lent you the money is going to demand more collateral, and if you can't post the collateral, the lender is just going to automatically start to sell your positions, and he's selling them wherever they're marked. Like, it doesn't matter if it's the bottom, and then you get this doom loop where positions are getting sold at the bottom. You're forced selling into weakness, which pushes prices further lower. It's going to trigger more margin calls. And like I said, it's sort of this doom loop. So that's sort of the little piece on leverage. And what happened here specifically was he made this massive bet on AI, levered the position up a ton. He made a bunch of money. And I think this is sort of the cherry on top, the key. Know when to get out of a position. I've said it so many times in so many different episodes. It's one thing to understand where your stop loss is if you're wrong. You know how many percent you're willing to risk on a trade. What is it worth? And once you hit that level, you sell, lick your wounds, you take a small loss, but you live to fight another day. The same principle applies on the winning side. If you think a stock has the propensity on your idea to go up 10 to 15%, you start to take off the position at 10%. You take off a little more, up 12%. You take off a little more, up 14%. And you sort of have this trail stop idea in your head. So if it comes back down to, oh, you're only up 8%, maybe you say, hey, I took off a good chunk at a good level. Now that it's come back down to 8%, I don't know that it's going to get to 15. And so if I'm going to manage risk properly, I'm going to take off the balance of my position up 8%. And I'm going to have a nice healthy gain on what was a great idea. Evidently, it was a great idea because you made, let's say, roughly 10, 11% there. Now, the lesson here was Leopold sort of allowed this idea. He thinks AI is going to be the next big thing 10, 20, 30, 40 years from now. That's completely fine. If you invest your money, i.e., no leverage, into one theme and you watch it play out, it goes up, it goes down, unless the stock goes to absolute zero, bankruptcy, it gets pulled off the exchange, you lose everything. Okay, you lose everything. But if you lever up the position, you lose your staying power because your entire equity can get wiped out and you can go into what is this negative equity. Like you could lose more than what you actually had in principal put up. And so nothing was taken off. He had no sort of stop loss for the winning side of the trade. Where am I going to get out if this trade works? Like remember, he was up 400, 500% or something. That is a great return. He made billions of dollars, really could have honestly, I mean, I know people don't like to retire and they love this job as much as I do and they want to continue to do it forever. But roll that money into the next thing. Sell some of these positions, book a nice healthy win. But that didn't happen, and he watched the whole thing roll over when we had this nasty sell-off over the course of a month and basically was forced to almost liquidate the entire thing. Citadel came in and bought his entire portfolio. I don't know, whatever the remaining money was left, I guess he returned it to investors. But this fairy tale story, investor story, turned into this catastrophic disaster because the one thing that I've stressed so many times on this podcast and on the short forms, know when to get out of your losers and know when to get out of your winners. The exits are so, so, so important. It's not so important that you nail the high or nail the low. It's never that. It's what do you think is reasonable for this name? You're never going to nail the high and you're never going to nail the low. So having a plan to exit a stock, whether it's a loser or a winner, you need to have a plan on either side, is extremely important in this game and detrimental to your longevity and your success trading, investing, what have you. So I am done with the ramble. That is the episode. Those are all the things I wanted to say. There was actually a lot more that I wanted to say, but this could be a 2-hour episode, and I simply do not have the time for that today. So thank you so much for listening. Again, I'm your host, Alex Ivanovich. I'm going to be posting these videos every single Friday from now on. I'm sorry about the little vacation that we went on. Go ahead, follow me on Instagram, on YouTube, and on TikTok. I do a lot of the short form content on there where I post some market updates. I talk about things I'm seeing intraday. And yeah, that's all we've got for today. Take care. I hope you have a phenomenal Friday and an even better weekend. I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.